Hi everyone, this is Prachi and welcome to the latest episode of Currency and Commodities Monitor. We have with us Ms. Rhea Singh, Currency and Commodities Analyst here at Emkay Global. Hi Rhea, how are you doing?
I'm good.
So excited to grill you today. Are you ready?
Yes, go on with it.
Okay, so let's start with currency first because there has been a lot of churn around the money markets and with the new RBI governor and Rupee at an all-time low. What action do you anticipate from here?
So, if you look at the currency currently, we have seen quite a depreciation into the Indian rupee, and the approach it seems that the new governor is taking is letting the Indian rupee to find its own tandem with respect to the other regional peers. So I think going forward also this will be the stand. It is quite different from the approach of a former governor, Shaktikanta Das, who concentrated more on the stability of the currencies. But I think the new governor will take a stand where, because Indian rupee is also very overvalued as compared to the other regional peers. So I think he will let the Indian rupee find its own organic footing in line with the regional peers, and at the same time he will be active in curbing any extreme volatility. So the stand will be to get the Indian rupee devalued or depreciating to come in tandem with the other regional peers, but safeguarding it from any wild swings going forward.
Okay. The US has new president and he's threatening tariffs. So do you see it affecting rupee in a big way?
So yes, we have new US presidents, and I think he has come with the quiver full of tariff arrows. It has already started impacting Indian rupee since December. If you see the depreciation, it has been quite fast paced. We have seen it depreciating 2.4% till now, and this is because of these tariffs threat that the market is currently factoring in. It has also led to quite strong momentum into the dollar index as well. So strengthening of the dollar is also one of the reasons why we are seeing such a huge impact on the Indian rupee. When it comes to tariffs, yes, tariffs would create a hurdle because right now he's talking about putting tariffs on Russian oil. So if you look at our importing numbers, so we have seen growth into the numbers of Russian oil imports. So we are somewhere reliant on the Russian oil, discounted price Russian oil, because it was the one factor which aided the India to sail through the crude prices before. So if the tariffs comes into place, the import price will rise for the importing of oil, and at the same time we are seeing Indian rupee battling the strength of the dollar as well. And if you look at the other counterparts, which is OPEC, so they will continue to maintain their oil policy, which is holding off their supply for the current year. So I think if the tariffs are put on the oil specifically on Russian oil, I think that will create a impact on the Indian currency quite too much. And of course, we are at a time where US economy is doing fairly good. So the interest rates are higher, and there is because the dollar is getting stronger, US economy also becomes very attractive for the investors, and our Indian capital market are the valuations are very high for the capital markets in India, so which has triggered outflows. So all these factors will continue to put a pressure on the Indian rupee going forward.
Got it. On commodities, New York Times has reported that the oil corporations of US are excited about Trump policy on fossil fuels, but they are not too keen on drilling more. Do you see this driving prices up in the near term? And what other factors do you think can impact the current trends?
So I think if you look at the Trump's campaign, so drill baby drill was one of the more prominent slogan that he has put forward into his campaign. So this is because he has an idea of America, curbing its oil imports, and because they have reserves to be a self-reliant, at least on the energy part. But if you look at the margins, we are talking about the refining margins. They are already very thin, which means the oil prices have to rise substantially to get those margins at a comfortable level where they can, all these oil companies can put in money or put in capex to get the drilling started. But that does not seem to be the case currently, because we are at a time where we are seeing sluggish demand growth into the oil, and like I said, the margins are thin. It is a welcome approach for oil and for oil and gas company. It is a very positive thing for them to happen at this time, because they were facing quite a competition from the green energy sectors. So it is a welcome step, but of course a lot needs to be done, and it is too early whether this will take an action in market, because like I said, the prices needs to be higher and the demand needs to be positive. We are in a surplus right now, so there needs to be a demand growth which will lead to increase into the margin and so forth. So I think it is a good initiative for oil and gas company, but it will take some time. It is still too early to say whether this will become a reality going forward, because US is already operating at a very high levels.
Got it. Gold has had a phenomenal rally since Feb last year. Beyond global central banks buying, what other factors do you see driving this up? And do you see the rate stabilizing in the near future?
So gold prices have rallied basically because there was a substantial buying by the central banks. Now, from the past 6 months, China had stopped buying. So they ended that period and they resumed their buying. So from last 2 months, we are seeing some buying momentum coming from the central bank, from PBOC. So we are seeing some numbers on their part. In the rally that had happened in the previous year, this was quite prominently done by the central bankers. So the retail participants had missed the rally. They had not participated in this rally. So for this growth to be supported in the long run, of course, central bankers will be the key factor for it, but also this will be more supportive. The rally will be more supportive if the retail demand also picks up. So because the prices are so high that it is putting a shadow on the retail demand currently. But going forward, I think there will be a growth if the ETFs float starts again. There was a little bit of positivity on the because we saw flows in the gold ETFs after quite some time. So if the gold ETFs picks up and central bankers again come into the picture with their aggressive gold buying, we will see a quite aggressive move. But I think there will be a staged growth into the gold in the current year, because there is a lot of uncertainty with respect to the tariffs. We do have tariffs uncertainty revolving. Then there is also the capital markets are not doing that well around the globe. So this gold also becomes a very attractive and safe assets for them. Apart from that, there is always, we are seeing some medium term spike into the inflation. So it becomes a very good hedge with respect to that as well. So it will be a supportive move for the gold, but for an aggressive, I think retail demand needs to come into the picture.
Great. On the back of gold, silver has been equally pricey. Do you think that China's stimulus will drive up demand for silver in China? This may push up and may this push up prices further.
So for now, I think silver prices were supportive on the back of gold momentum, and that part will always be there. But for if you look at the momentum that we have seen in gold as compared to the silver, it has not been much, where we have seen it breaking highs. Silver is still picking up. It has not been able to break through $32 and sustain beyond that. So this is because China is not performing well. Over the globe, we are not seeing pickup into the manufacturing sectors. So because silver is also industrial and manufacturing, metal, for it to rally what we are seeing, I think manufacturing and industrial sector needs to pick up. We have seen some stimulus coming into the China, but it has not been able to sustain growth so far. So for silver to perform on its own, apart from piggybacking on gold, I think the numbers in the industrial numbers and the manufacturing numbers needs to improve.
Okay. Copper and aluminum, on the other hand, have been declining. Do you foresee weak demand for those in coming quarter?
So the base metals, especially for copper, I think the same strategy applies. We have seen stimulus for the for China. Now China is on a path for stimulus, but we need to for base metals specifically, we need to also factor in how are the housing market performing there. Now if you look at the growth into the housing prices, they have been stagnant. There has not been much pickup on that part, and plus if you look at the deposit rates in China, so it is continuously rising. So this is indicating that the consumer or the people are still very cautious about spending too much into the economy. So this will not get translated into any growth when it comes to the real estate sectors. Also, the steps taken so far has not been sufficient to get the real estate back on its feet. There have been very targeted steps, but more aid and more policy easing needs to be done for the liquidity to start getting into the real estate sectors. Only then we will see some pickup into the into the base metals. Otherwise, I think it will be anywhere between 9,000 to 10.5k per ton going forward.
Okay. Thank you for the insightful and engaging discussion, Rhea. Pleasure interviewing you. That's it for today's episode of Currency and Commodities Monitor. For more thoughts and enlightening ideas, subscribe to our channel. Like, share and subscribe. Thank you.